Good morning, everyone. Is this on? Can you hear me? You can? Good. My name is Gavin Kelly. I run a think tank in London called the Resolution Foundation, which looks at a whole bunch of issues, some of which are very relevant to what we're talking about this morning. A warm welcome to everyone who's come along. I'm sure more will be trickling through the door as we get going. This session has a sweeping title, National Strategies, Value Creation, the Distribution of Income and the Structure of Careers. What it lacks in brevity, it makes up in ambition, I think. And we have three fantastic speakers this morning. I'm not going to read out all of their biographies because that would probably take about 5 minutes of their time. But you will probably know several of them. Starting on the right, we have Bill Lazonic, then we have in the middle Marie Carpenter, and then we have Mario Pianta. So they will all be speaking for 15 minutes. I'm going to set my stopwatch to try and keep us in some sort of time, and then we'll have plenty of time for discussion with you afterwards. So with no further ado, I will turn to Bill.
Okay. Yeah, well, this paper, you can see the title. Sorry, you can see the title, understand why I gave it that title by the time you get to the end, which I'm going to go through very quickly. It is available as an INET working paper, quite apart from using it for submitting it to this conference. Okay, and there's some other papers that are related to this that are on the INET website. There's 3 different papers. Okay, now here, these are graphs that a lot of people have seen of wages tracking productivity post-World War II decades in the United States, and then this divergence. In the 90s with Mary O'Sullivan, we started talking about retain and reinvest allocation regimes, and that's what you have at the top there, post-World War II, and then downsize and distribute. Basically, companies retaining people, retaining money, reinvesting in the organization, growing, and then moving into a very different type of allocation regime. Now, as a result of this is been something that people have been noticing since the 1980s, which I've been following, a disappearance of the middle class in the United States. And here's the central notion. If there's new economic thinking, it's what I call CCCs, collective and cumulative careers. That's why there's that growing gap, or that's why wages are tracking productivity post-World War II, is that, in fact, it's not a matter of jobs. People talk about jobs and a wage. It's a matter of having a job for 40 years that can pay a high level of a high salary, that has high productivity, that can support a decent standard of living. That's what a middle class is, and that's what it's been certainly since in the last half of the 20th century until now. And if you don't have that, you don't have these collective and cumulative careers, then you're not going to have a middle class. Now, you'll see in a minute why I call them collective and cumulative careers. In the 1950s, people were writing about this. This was long before people were writing about the Japanese salary minimum permanent employment. You had it in the United States, and it actually persisted into the 1980s. The seminal book, and really a neglected book, it's a classic. Edith Penrose, A Theory of the Growth of the Firm, that's defined as a book that everybody cites but nobody's read. It's absolutely incredibly insightful and important on this understanding that organizations are really creating a middle class. It's not the market. And it's basically large corporations, corporations that grow large. And if they don't continue to do this, you don't have a middle class. And the way they did it post-World War II was a career with one company. Now, these are the latest data that have been collected by the Bureau of the Census in the United States on domestic employment by size of firms. You can see about less than 2,000 firms with 5,000 or more people. A tiny fraction of all firms, but about a third of all business employment, 37% of payrolls, 43% of revenues, and lots of small firms are dependent on the resource allocation of these large firms. So this is a larger part of what I do. Is that economics is about the allocation of resources, but it's the allocation of resources by very powerful actors, and if they don't invest in productive capabilities, and if they don't generate productivity within those organizations, number one, and share them with the employees, then you don't have a middle class. Okay, the reason I call this collective and cumulative careers is because I think what economics is missing in general is a theory of innovative enterprise, or we call it a theory of productive enterprise. And at the heart of this is a collective and cumulative learning process. And this is really the accumulation of human capital, investment in human capital. And if you don't have it, you don't have high productivity. And the question is, how does that occur? Now, the way it occurred post-War II in the United States was in major companies where basically you had a job for career. And it doesn't mean everybody, when they got in their 50s, up to point of retirement, maybe in the early 60s, remain productive, but in general, this is what sustained productivity and the middle class, and this is where you generate innovation. We have a critique that in some of the papers that I flashed at the beginning of skill-biased technical change. At plenary, Joe Stiglitz said it was right in the 80s and 90s, but not now. It was wrong all along, and I'll show you why it was wrong all along. And here's why. Basically, the problem of the middle class, the erosion of middle class jobs in the United States is a structural problem, but it's not a mismatch in the labor market, because when companies want to have a match, they make the match. They train people and then they retain them. That's the way it works. And if companies are saying we're not going to do that, then you have a problem. And what happened starting in the 1980s, there were three changes, major changes in employment relations that occurred in the United States and that would have occurred under any circumstances. One what I call rationalization, second marketization, and globalization. Rationalization characterized by permanent layoffs of blue-collar workers. For the first time, plants would be closed, they wouldn't be open, and this became a kind of something that companies just continue doing. Marketization, the end of career with one company, which really started on a large scale at the beginning of the 1990s, and then globalization, which goes back much further, but an acceleration of offshoring of jobs to capable people in low-wage parts of the world. Now, all of these occurred, and I'll go through this very quickly, each of them, because of something to do with a productive rationale. It wasn't just that companies wanted to get rid of these employment relations. But once they kicked in, financialization took over, and companies found that if they just got rid of blue-collar workers, got rid of permanent employees, globalized production, well, they could cut costs and make more money and distribute more of it to shareholders. And that stuff about distributing to shareholders I'll come to at the end. Okay, the rationalization, and what we see is it actually gets initiated in recessions, but then it continues after that, and it becomes basically jobless recoveries in the aftermath. So in the early 1980s, it was the first time that companies on a large scale closed plants, and it was a response to superior competitive capabilities from the Japanese, where they integrated down to the shop floor. Marketization, it really came out of the information communication technology industries that had to do with the rise of open system architectures. And globalization, there had been an accumulation of capabilities, particularly in Asia, through a process that goes back to the 1960s that started with semiconductors going to those Asian countries for testing and assembly, that in many ways drove the East Asian so-called miracle. And by the 2000s, through communications technology changes, through the development of the internet, et cetera, this could take a much more wide-scale form. And finally, the most recent recession, the financial crisis, was purely a financial crisis, but it exacerbated the vulnerability of the labor force in the United States that because of rationalization, marketization, and globalization. The rationalization of the early 1980s, it was a jobless recovery, not for the economy as a whole, but definitely for blue-collar workers, and it hit blacks the hardest in the United States. It was a huge deterioration of the advance that African Americans had made in the U.S. economy because of the occupations that they were in. This is really the Achilles heel of American manufacturing. And there was the Japanese with their institutions of permanent employment that outcompeted the United States. And Here's what's wrong with skill bias technical change. They actually noticed this disappearance of the blue-collar jobs, the increased demand, which I showed in the previous slide, for computer-type jobs, and they call this skill bias technical change. Well, that's supposed to be happening in the workplaces in the United States. But it wasn't that the American blue-collar workers were being replaced by computers. They were being outcompeted by the Japanese, and the Japanese then and now, with permanent employment, are by far the leaders in robotics. I could go into why that's the case, but I don't have time. Marketization, this was IBM. You can read Louis Gerstner, When Elephants Learn to Dance, or whatever he calls his bestseller book. It was about getting rid of lifetime employment. A company that exemplified lifetime employment, that bragged about it up until the 1990s or beginning of the 1990s, that it hadn't laid off anybody involuntarily since 1921, deliberately got rid of it. And it was in part because it was in an open systems environment where experienced workers, proprietary technology, those corporate research labs, were no longer seen as valuable as just new rapid product development, in IBM's case, moving out of hardware into software and services. Skill bias technical change, they ignore it entirely. Why? Because everything in skill bias technical change is about the education you have, supply and demand in the labor market. That is not what creates wage inequality. It's what kind of jobs you have and the 30 or 40 years or 20 years or 10 years you have of a career that raises productivity, where there's a retain and reinvest allocation regime. Totally ignore it. This is just one example, a good study, and we need lots more of this, by Brown and Linden, that was done a few years ago, of the semiconductor industry. Globalization, again, it started in the 60s. Every semiconductor company in the United States by the 1970s of any size was doing testing and assembly in East Asia. And when they employed literate but low-wage female labor as operatives, they employed engineers and managers, indigenous people, as to run those plants. And that, you can trace it through. I have done this in a book of mine, led to South Korea, led to Taiwan, it led to Singapore, even led to Malaysia. Okay. This was a well-known Business Week cover page, an article, Is Your Job Next? People started noticing this in the early 1990s. This was actually the second thing that was called the jobless recovery. The first was after the recession of 1990-91, when companies kept laying off older workers. Now you're laying off people through globalization. Okay, the financialization side. This is what I've been working on a lot for the last number of years, because this stuff is going on. It's not a matter of going back to the old career with one company system in the United States, but you do need to have collective and cumulative careers. An economy, and Mario will talk a lot about this in the European context, needs to have some way of preserving and enhancing human capital, or you cannot have a middle class. Okay? And so you had, basically, as this was going on, for a lot of reasons that had to do with the transformation of Wall Street, the rise of people looking for higher returns, even households, through their pensions, through their retirement, through their savings, to higher yields, which are coming out of companies. You have companies moving away from investing in their labor force, which they could have done even with these changes, and could have taken advantage of the changes and built on the changes, some companies did, to just trying to, in fact, create value for shareholders. And the way they've done it, basically, is whenever they have the profits, they distribute it, not just in the traditional form of dividends, but often also in buybacks. And this graphic there, I was going to show it instead of giving a talk. It's a wonderful, I think, 10-minute video, animated graphic that Harvard Business Review did, based on an article that I wrote in Harvard Business Review published last September, called Stock Buybacks, it's called Profits Without Prosperity, Stock Buybacks Manipulate the Market and Leave Most Americans Worse Off, which is not a typical Harvard Business Review title, but there it is. Now, here's the extent of it. These are net equity issues in the United States from the Federal Reserve Flow of Funds data. last decade, about 400 billion negative per year. So companies are financing the stock market, they're financing the hedge funds, they're financing Wall Street, basically. This is gross equity issues. This is tracing companies back to the early 1980s, and there's a lot of story that goes into what changed in this context. But basically, in 1997, buybacks surpassed dividends as a form of distribution to shareholders, and there's a difference. Dividends pay shareholders for giving them a yield for holding the stock. Buybacks pay shareholders to sell the stock. So recently, and I've written about this, General Motors yielded to the hedge funds and did $5 billion in buybacks. Basically, General Motors was taking $5 billion of its dollars and saying, sell our stock and make some money out of it. A lot of the work I've done has gone into looking at particular companies and the impacts of how you'll hear some of it from Marie, because we have a joint paper with a couple other colleagues on Cisco Systems and the impact of stock buybacks on that company. And I've looked at a lot of these different companies and of what's gone on within them. Underlying all this is the most damaging ideology ever to come out of economics, maximizing shareholder value, which comes right out of neoclassical economics. It's the economics that all neoclassical economists teach. It's in the textbooks of Krugman, of Stiglitz, in their undergraduate textbooks. It's all there. It's an insidious ideology because it says people who have nothing to do with the company, who are just buying and selling shares, they get to grab all the money. And part of the problem is in the early 1980s, the Securities and Exchange Commission in the United States, which is supposed to regulate the stock market, encouraged this practice. And that's another long story, which we're doing a lot of research on with a fellow named Ken Jacobson, on how Reaganomics got very quickly embedded in the Securities Exchange Commission and helped, actually was fundamental in promoting this process. Okay, just very quickly, back to the title. You've probably seen this in other contexts. The Piketty-Say's data, wages are a very important part of the pay of the top 1/10 of 1%, or whatever the top fractile you take. A big portion of that is stock-based pay. Here are some data on this. So when people talk about those bonuses on Wall Street, well, that's not quite correct. The bonuses are tiny relative to the stock-based pay. So if this is for 2006 to 2013, where the data are consistent, it's between 66 and 84% of the top 500, their pay is from stock-based pay, which is boosted by stock buybacks. And timing is everything here. And there's again, there you see a paper there came out from the Roosevelt Institute on this. Piketty himself, in his book, he talks about the super managers. So it turns out it's not capital in the 21st century, it's labor in the 21st century. It's people who are employees who have captured these companies. And there's some data that show this. If I can just get to the bottom line here. You can't understand the economy without understanding productivity. You can't understand productivity without understanding how people gain expertise, are part of learning processes over time. And that happens in companies. It does not happen on the labor market. There's a whole number of policy prescriptions. I would ban stock buybacks, at least open market repurchases, entirely. They're just a manipulation of the market. Even Harvard Business Review agrees with me. Regulate stock-based pay. It's totally self-serving, and it should be tied to real innovation, not to something which is based on speculation and manipulation of the stock market. Put taxpayers and workers on corporate boards, not because this is nice to do, because they create the value that is being distributed to shareholders, and they're the ones who can stop that happening. Fix a tax system so that, in fact, people who are making money on government spending, on workers working hard for them, end up paying their fair share of taxes. And finally, to get back to the main theme of this talk, nobody in the United States is thinking about the careers, preserving and enhancing human capital, about careers. People get laid off with a lot of education, a lot of experience, and they just disappear. And this is valuable human capital. Almost any economist would recognize that's the case. So some people should start looking at it, and we've started some research which is trying to do that. Thanks.
Fantastic. Thank you so much, Bill. Brilliant to see the connections between corporate finance and careers and pay set out so clearly, and you've given us a policy programme for people to get stuck into. If people can't react to that list of proposals, then something's wrong with you, in my view. So there's lots to discuss there, but we will move straight on to our second paper from Mario, who's going to put this in a European context. Thank you.
Thank you very much, Gavin. Thank you for this invitation to this very interesting conference. I will try to complement Bill's presentation on a variety of dimensions. First, looking at the European story, as well as the American one. Then looking more carefully at the impact of the recession on European economies, and identify some elements of what we can understand as a structural transformation which has been accelerated by the crisis with, first of all, an overall job destruction. We are not talking about anymore jobless recovery. We are talking about no recovery at all. Even if we have jobs, these jobs are going to be precarious, low-paid, and low-skilled. So, in a way, in a context where the European economy is shaped very much by small and medium-sized businesses, much more than in the US case, we see a lot of the weaknesses of this transition and much less of the gains, even the financial ones, which are much less visible in most European countries. So we have a situation of very little prospect for growth in most of Europe, deep changes in the international production system, which were already mentioned by Bill, and also deep changes in labor relations, which are really shaping a new labor regime where precarious labor contracts, the breakup of unions, and labor market reforms, some of them pushed through by international organizations, and unfortunately even some OECD policy advice had been going in the last decades towards labor market reforms that forget all what is happening outside labor market as an important aspect. So the bad news is that unemployment is huge in Europe, and basically is huge also because there are 4 different types of unemployment which are mixed up. The first one is the one brought by the recession and basically by austerity policies, so it is a Keynesian type of unemployment because there is no demand. The second type has to do with the structural employment, with the structural change from all to new industries, from manufacturing and services, but there is a huge cross-country and cross-regional dimension in Europe that we will see. Then we have the technological unemployment brought about by technical change, and we have a huge segmentation of labor markets now with basically a division of subsets of activities and labor contracts for young people, for immigrants, from precarious workers, which are really shaping in a totally different way the way employment changes. So looking at what happens to those who actually have a job, we are seeing a more polarized center-periphery structure within the EU and a radically changed professional structure. Let me focus on this professional structure group, because I think that's a quite important complement to what Bill said. This is an overall picture for the major European economies on how the recession has really destroyed the jobs, not only in manufacturing, but also in services. And here is the picture of the polarization within Europe. Most of the job losses during the recession have been in the South European countries, Italy, Spain, Portugal, and Greece. Modest losses in Eastern countries, and basically the Northern European countries have been surviving these job losses even during the recession. paradoxically, Europe South had been the area where there was the fastest job growth during the good times before 2008. So what we are really seeing is a structural transformation of the dynamics within Europe. And here you have more details about the dynamics of industrial production. If you look at, if you compare the level of 2008 before the crisis of a gross industrial output, you see that Southern Europe has lost between around 25% of its production capacity. 7 years after that, this is not a temporary downturn, it's a structural destruction of capacity. Of course, this is a major element of a divergence within Europe, and this will, if there is a recovery, this will mean a balance of payment deficit in the current accounts, and this will mean more flows of capital and more debt, private and public, to compensate for that. So we are really facing a deep structural transformation in the distribution of industrial capacity, and of course, the other side of the story is the boom of youth unemployment in these countries, where youth unemployment is reaching now between 30 and 40% in Southern Europe. One interesting way to complement Bill's story is to look at the ISCO professional classification of skills, and we propose to focus on these 4 major groups: managers, clerks, craft workers, and manual workers, because this is much a better story than the skilled, unskilled story, or educated, uneducated worker story, and this allows us to understand much better what is really happening. You see that the wage structure of these groups is really reflects the different skills, and so is a fairly solid description of what is happening. And this is the story for the 5 largest European economies. The upswing is a period of until 2007, before the crisis, is a period of polarized growth. There is no skill bias, there is no upskilling of jobs in Europe. There is a polarized transformation with the losses of clerks, white collar, and skilled blue collar workers, and the growth of technician, professional, and managers on the one hand, but also of manual workers doing menial jobs especially. When the crisis arrives, this transformation destroys especially the blue-collar base in the same direction, and some clerks in the same way that Bill was explaining a moment ago. The story is, again, much more serious in manufacturing and less serious in services, except for some groups. And you see in services how deep is this polarization of employment change is taking place. We are creating a lot of low-skilled, low-paid jobs with from fast food to simple services, personal services, and so on. And of course, this reflects a transition in the contracts, where you have mini jobs in Germany, which are now 4 million of workers earning less than 4 euros per hour with the new labor market reforms introduced a few years ago. Italy is going the same way with the introduction of much more precarious and less secure job regimes. Other European countries is going the same way, and of course the services lead the way in this direction. In several studies with some colleagues, we have explored the determinants of employment by professional groups. First of all, just let me give you a very short summary. First of all, if we look for what are the reasons for that shape employment change, of course we have demand, wages, technology, and we distinguish between process technologies, which is associated structurally with job losses and restructuring, and the new product technology, which is associated to the emergence of new markets and the possibilities for job expansion, as well as education. What we see, first of all, is that each professional group has a different set of determinants. We don't have one labor market and the same determinants for each of the skill groups. Secondly, what we see is that during upswings and downswings, the story is totally different. For instance, the potential dynamic role of technology, of new products, creating new jobs, is visible only during expansions and totally disappears for all jobs, for all types of skills during the downswings, where the main story is the introduction of technologies in new processes and new organization which destroy jobs. This would take us to greater detail, and you can see later the references to this paper. Of course, these conditions in employment are translated into a worsening of wages condition, not just because we have this is from the ILO wage report, these losses in the wage share across the advanced countries, and what already Bill showed, the lack of the ability of wages to catch up with the productivity growth. But as a matter of fact, even in the dynamics of wages, we have a different effect of different types of technologies and different types of ability of different skills. For instance, the negative relationship between wages and employment, the neoclassical labor market story, is very real for low-skilled workers and is not so real for managers, because managers can set their own wages. So what you see is that the relationship between wages and the elasticity of employment is deeply different. Summing up some of this evidence, we are facing in Europe, but it will be interesting to match this story to the American one in a more systematic way, a greater inequality and a greater hierarchy within European countries and within the skill structure of jobs. This leads obviously to greater inequality in income distribution, less access to the gains of productivity, and growing problems of social integration, which are compounded by the dynamics in labor market arrangements and wage regimes. What can be done? Lots of things can be done. We are lucky that even the IMF is saying now with a new paper that unions help to reduce inequality. So all types of pro-labor policies, pro-unions, anti-inequality policies, limiting labor market flexibility and reducing labor market deregulation can help reverse and limit these dynamics. Clearly, this is a U-turn vis-à-vis what has been the mantra of international organization in the last 3 decades, but the evidence from the US and from Europe is quite uncontroversial that if we continue to go in this direction, we are losing productivity, we are losing growth. We heard a couple of days ago all the speakers at the opening session of this conference, including the president, the director general of the OECD, saying that inequality is bad for growth. And the roots of inequality are in these elements that we have been identifying this morning. I will focus in terms of policy not on the first set of topics, but on the industrial structure dimension, because I agree with Bill that the potential for growth is in the ability of economies to retain productive competencies, to return firms which are able to produce, to return industrial structure which are efficient and alive. So we have to be very careful in these structural roots of the dynamics of inequality and polarization in Europe, including the increasing divergence within European countries. And therefore, we have to focus on activities with learning, innovation, demand and productivity growth, because in the end, the future of labor is not decided in labor markets, but is decided in productive systems. And let me just very quickly refer to a set of proposals that have been emerging in the last couple of years for a new European industrial policy. Many people may not like the term, but we have been spending 30 years expecting firms to make an optimal decision, allocating efficiently resources in the short term and investment in the long term. The result has been what Bill has just said, stock repurchases and financial gains, forgetting about the productive reinvestment in a lot of activities. And it's interesting that even the EU has realized that, because in the last 2 years there has been much talk about an industrial compact, and very recently the president of the European Commission, Juncker, proposed a Juncker plan with not so much money, but which goes in the direction of funding new investment in productive and strategic infrastructure areas. But there has been much more proposals coming out from the German Trade Union Federation, from the European Trade Union Federation, from the collective of the Euro Memorandum economists, from the Greens of Europe, basically saying that what we need to do is a European investment plan, and the order of magnitude which is needed for getting Europe out of the recession, therefore solving the macroeconomic problems, is about 2% of GDP per year, probably for 10 years. If you do this type of investment, you end the recession, and you are able to reshape industrial specialization of Europe towards 3 major directions, which are crucial for today's growth, and we will hear more about some of these later. Clearly, we need to move to transform our economy into a sustainable path with environmental and renewable energy production, with a massive saving of resources, and taking a new model of development which is environmentally sound. Secondly, we have to extend the application of ICT and distribute them and across the economies and obtain gains from productivity in these fields. But also we have to look at an additional fields where Europe is the world leader, that is health, welfare and caring services. No other country has had the same success as Europe in this field, and this is why, because learning from our British pioneers with the welfare state in the after post-war period, the public sector has been running the show in this field. And therefore, we have to understand that public activities and public investment in fields which are now at the frontier of technological change with biotechnology, medical services, and so on, is really a field where, basically the common sense idea that innovation comes from the private sector and the fast-growing activities are in the private sector is not justified anymore if we look at issues like this one. So there will be a number of proposals that can sustain this. Let me just conclude showing to you this evidence that in these fields that could be the targets of these industrial policies, the skill structure is very much shifting to the to the higher skills, with very high shares of managers, technicians, and professionals, as well as clerks. And therefore, there is a coherence between a policy that pushes the economy toward the structural change and the transformation in the labor market and the career path that Bill was talking about. There can be very diverse tools. One was mentioned yesterday here by Yanis Varoufakis when he was saying that to rebuild the Greek economy, which is a dramatic case study of this losing of ability, we can really have the European Investment Bank putting out bonds, which can be bought by, on the secondary market by the QE of the European Central Bank, and we have at last some form of feasible Eurobonds that can go not into the financial cycles, into the financial dynamics of, and which currently is unable to reach the real economy, but can go straight to a productive investment which can be successful for us. So here there is a list of papers where some of these discussions have been developed, and I think that this combination of linking an understanding of what are the roots of the changes in the labor markets and what are the broader implications for macroeconomic condition, employment, the future of our labor markets, and our policy perspective is a very important way of combining different perspectives in this end. Thank you.
Thank you, Mario. And I thought that tied together very nicely with what Bill kicked off with. Our third paper is going to look at some of these issues in more detail in a particular sector. So over to you, Marie.
Thank you. I hope my paper will be complementary to what we have just heard. I will be looking very specifically at the telecommunications equipment sector. And after I give you a quick overview of how the industry functions, I will give you a presentation. I will explain the outline of the presentation and go on to give you some of our conclusions in relation to three of the companies we find particularly interesting at the moment: Cisco, the Silicon Valley company, Ericsson, the Swedish firm, and Huawei, the Chinese company that has entered the industry more recently. As none of you will be surprised to know, the telecommunications industry has grown very significantly. Those of you who pay the telephone bills for several members of your family will be aware of this. So it's quite a healthy industry. From our point of view, more upstream in the telecoms equipment industry, we are talking about a cyclical industry. It has a relatively healthy growth of 5% a year, and as the industry is worth about 250 million euros, which is more or less the same today almost in dollars, that's quite a healthy growth rate to be adding into the industry every year. However, with the cyclical nature, we also have to add in a very regular technological change. So none of you will be surprised to know after 4G, we'll have 5G, etc. And even within those transformations of different generations, there are different technological choices. So every couple of years, there are going to be, the cards are going to be kind of redistributed among the actors. So it gives it quite an interesting level of competitive dynamics to add into the equation. It is an industry that has another specificity that is quite interesting, which is that because of what we call convergence, we have players in the industry coming, on the one hand, from the telecommunications, traditional industry, but also coming from the broader IT sector. So we have some very old players in the industry, such as Ericsson, who are traditionally telecom firms, some older firms, such as Fujitsu and NEC, who are coming from a much broader base, but have also been around for over a century. And we have new entrants coming from completely related but separate industries such as Cisco, but also new entrants into this growth industry from the new emerging economies such as Huawei and ZTE. So we bring into the mix quite an interesting group of different national structures for employment and for innovation and for technological development, and also different ages of companies. In our research on this sector that I'm going to present to you, I'll present it in two parts. First of all, what happened before the bubble and coming up to the bubble, and what the fallout was of the telecom bubble, which exploded in 2001 for the major players across the world. And obviously this is an ongoing study because the game is not up and there's a lot of new technologies emerging. So the bubble dynamics that we started to study in the late 90s were very much driven by the entry of Cisco into this industry from Silicon Valley, which became the world's fastest growing company during this period. It moved from an industry where it was selling to companies and was moving into this bigger industry where it wanted to sell to telecom operators who were buying the equipment on which the internet was going to be running. It also has the specificity of initially being quite not very well known. It was known as a stealth company, and it became, in fact, very well known for developing this acquisition and development model as an alternative to plain old vanilla R&D. So it saw its development of new technology as being more effectively done through the acquisition market than being built through large teams, as had been the tradition before in this industry. The other companies, such as Lucent, which was described at one point as a 100-year-old startup when it was spun out from Bell Labs, where Bell Labs was spun out from AT&T, tried to become a new IP player through various acquisitions, one of which was quite enormous, and we'll see an example in a moment of how these acquisitions became very large. Nortel, the Canadian player, announced it was going to succeed in a 90-degree turn. Unfortunately, that turned out not to be the case. And even in France, this influence of the Cisco model became evident when the CEO announced that Alcatel, the old conglomerate that was becoming a telecom specialist, was going to become fabulous. And this created a lot of very negative publicity among the French newspapers when the union started to object to this. The UK conglomerate, which had been GEC and was focused on telecom to become Marconi, really pushed it to the extreme when all of the money that it had made selling off its other businesses in defense, for example, was used in cash to make 2 enormous acquisitions in the United States, as the company set itself up basically to be acquired by one of the other players, but didn't actually manage to do that in time. We have a colleague in Stanford, Kenji Kushido, who has looked at what was happening in the Japanese market at this stage, and ironically, from the point of view of public policy, this seems to be an example where very extreme levels of competition among national players seem to over-concentrate them on the domestic market, which was very dynamic with a very large customer who was very demanding, and made them kind of insular, and Kenji has called this the Galapagos effect of the Japanese players who remained very national and became niche players. So as I said, during this bubble period, the influence of Cisco making these acquisitions turned acquisition into a very clear strategic priority for the companies. And you can see the very large level of acquisitions that were made during this time. But of course, it's very important to realize that these were stock-based acquisitions. So what was driving, apart from, unfortunately, for that company, for Marconi? What was driving this was that Cisco was part of this bubble economy. It was a real company. It was truly growing, and it was truly creating innovative technologies. But it was also part of the bubble that was being built up around the internet and telecom. And at one point in March 2000, Cisco became the most valuable company in the world, worth almost 550 million, with sales of 5 billion at the time. However, naturally enough, what goes up must come down. And the first company to feel the effects of the bursting of the bubble was our friend Marconi in the UK, who had literally emptied its coffers, making a cash-based acquisitions in the United States for reasons linked to its prior corporate governance as a large conglomerate with defense contracts. The next company to disappear as an independent company was Lucent, that in 2001 had considered merging with Alcatel and ended up in 2006 being acquired by Alcatel. Next, Nortel in Canada was sold off in different parts. Motorola was originally sold to Google and has just now been sold for $3 billion to Lenovo in China. So our conclusion of this period of the bubble leads us to believe that the North American companies basically destroy themselves as they adopted a far more financialized model than had traditionally been the case in this industry. The European companies were not as able or as enthusiastic, in the case of Ericsson, in adopting this model and survived more easily through the downturn that happened after the telecom bubble exploded. And we have been left really with Cisco as a very strong player, to some degree, ironically, because it had not succeeded in entering the telecom market as deeply as it had hoped. So when the telecom bubble burst, it wasn't as badly off. It had a huge inventory write-off, one of the biggest in corporate history, which was quite ironic, as the company has great PR saying that it is a virtual company with no inventory. And after this unfortunate event, and obviously its share price fell from its enormous peak, the company began a practice which we will now look in the post-bubble phase has become very dominant, which is to start buying back its own shares, the stock buybacks that Bill talked about. So from our point of view, at the end of the bubble period, Cisco was very well positioned. It had suffered less. It had a dominant position in its original industry, the enterprise business, and the other companies had really either gone out of business or were in a very fragile position. So it appeared that Cisco should have been in a position to penetrate the telecom market. The company itself was very clear that it planned to do this. As the recovery took off in 2004, Cisco said, yes, we are going to move outside our original businesses. They're still 70% of our turnover. We want to target these new growth businesses, which they call the billion-dollar businesses. There's a list of 7 of them, and 3 of them are in the telecom market. So Cisco says, again, now we're recovering, the telecom market is picking up, we're moving back in there. And it targeted the optical, IP telephone, and the wireless industry, clearly. It's really difficult to say that Cisco has not really been a success as a company. Bill has talked about downsize and distribute as one of the strategies. We can't say Cisco has downsized, but what we could say, and what the term Bill is using now, is dominate and distribute. So Cisco continues to dominate its original industries, and it continues to be successful. But what we find quite extraordinary is that it has not achieved the success it set out to achieve in the telecom market. Despite being in such a strong position. So its CEO, John Chambers, has come out in public in 2011 and said the company was disappointing the markets. It was not doing what it was said it was going to do. What he did not say at that time, however, when he did say the company had to change, it had to become better, it had to become far more successful in operationalizing its strategies, he did announce that 12,000 people were going to be laid off, but he was not as vocal in expressing the number of buybacks that the company was starting to make. And over the 12-year period up to 2014, Cisco has spent $89 billion buying back its own shares during the period that we've looked at. Despite, in the period just of these last 5 years, spending $32 billion, its share price, which is the bottom line, is not keeping up with its peer group, and it is not keeping up with the Standard & Poor's 500. So we can only imagine that without spending this enormous amount on buybacks, that its share price would not have been even in this position that it was. So our question as we enter the second phase is, what is the cost of this obsession that Cisco has with buybacks, where it has reached a point where it is spending up to $7 billion a year buying back its own stock? Albeit, certainly it does spend up to $5 billion a year doing R&D, but it is spending on average per year more than this amount buying back its own stock. So we're not the only people in the world questioning whether Cisco is as successful as it may appear to be on paper, because it does continue to increase its turnover. So one of the leading earners, the super managers, John Chambers, has become increasingly attacked in the press as somebody who has not been able to transform his dominant company. So yet again, we have one of these companies that is dominated in its original markets, has a very large cash cow, 2 very large cash cows in servers and routers. So what is particularly interesting about our story is that we believe that Cisco's missed opportunity in this telecom equipment market, as the market began to improve, was Huawei's success story. So one of the 2 firms to become a global player from China. And what's worth noting in particular is that Huawei is not a state-owned enterprise to begin with. ZTE, its competitor, was a state-owned enterprise, but Huawei moved from the Chinese market originally into developing markets, Russia and in particular Europe. Huawei today, since 2013, is the number 1 telecommunications equipment manufacturer. And just to put a date on it, Huawei was created in 1987. Cisco was created in 1984. So we're talking about 2 companies of very similar ages. So Huawei has just overtaken Ericsson in terms of global market share. But it's very important to point out that Huawei does not sell anything in North America, as it excluded from this market, this very, very large telecom equipment market, for reasons of national security. So it has this largest global market share without being in one of the world's most important markets. If we look in detail, and don't worry, I won't give you all the details, if we look sector by sector, we can see Cisco, for example, although it declared that it wanted to become number 1 or number 2 in the optical equipment market, we can see the line that goes down. It stopped investing, it stopped patenting in this industry as Huawei began to patent very seriously in this high-tech sector segment of the industry. You can't really see it very clearly, but the big red line that's growing is Huawei. So Huawei starts to take significant market share to replace Nortel that pulled out of this market. And the Cisco line never really grows over the whole period when Cisco was meant to be striving to become the number 1 or number 2. Ericsson, our Swedish competitor, as has already been said by Mario, it's very important in many of these high-tech industries to move from hardware to software. So Ericsson has been very successfully making this transition, very gradually bringing its workforce from what used to be the required skills in the industry to what are becoming the required skills. And both Ericsson and Huawei, in our opinions, appear to have achieved the level of deep competence building in this industry that Cisco, this complex industry made up of many different sectors, that Cisco does not appear to have been able to build. So our research is obviously still ongoing, and it's following a methodology which Bill likes to call the integration of theory and history, and in this case, history that continues to be made. We're using a multiple firm analysis in the sector. Bill is comparing the sectors in a broader study with other sectors. And our aim is to try to understand how the social conditions that Bill terms organizational integration, strategic control, and financial commitment impact on how these firms develop and maintain the innovative capabilities that they need. Our overall conclusion at the moment is that Cisco became over-financialized after the internet bubble and telecom bubble burst, and that this and its obsession with buybacks has now a negative effect on its capacity to build the types of architectural substance and the collective and cumulative learning processes that are needed to succeed in this industry. On the other hand, we feel that a very old Swedish company, Ericsson, and quite a new Chinese company, Huawei, although they've come from very different backgrounds, they do appear to be building these necessary competencies. Both also have the necessary financial commitment that is necessary first to build, but also to continually rebuild the collective and cumulative skill base that is needed to continue to innovate in this complex telecom environment. And finally, we feel that this type of study, this type of industry-level study, is what is needed to be integrated into discussions, on the one hand, of public policy and employment policy, and also into the larger questions of how the financial economy has an impact on the real economy. Thank you very much.
Thank you, Marie. Excellent. And thanks to all three speakers for being punctual, which leaves us time to have an open discussion. I'm going to ask people for their questions. While you're formulating them, let me abuse my position by just kicking off by asking Bill a question, if I may. And right at the heart of your argument is, and I'm doing gross sort of simplification here, seems to be the tight link between what is happening to executive incentives and pay and what's happening to middle-class jobs and working-class jobs, putting it really, really starkly and crudely. In terms of what we do about that, I'd really like your take on how much of the problem we face is really one of politics and political economy, that it's just so hard to get a government feeling that confident enough in its kind of coalition of support that it can do what's needed. So how much of it is just a straightforward politics problem? And how much of it is really a public policy problem too, which is, do we really know, how confident are you that we actually know what to do, which can deal with the problems you set out without having lots of unintended consequences? So just give us your take on that balance before we open up to others.
Okay, well, yeah, well, actually, since you're based in the UK, I think it's different in the UK that during the 1990s, there was a number of business sector commissions on good corporate governance, the Cadbury Commission and a number of Greenaway and a number of them. And it did lead to a code of good corporate governance, which actually put certain performance criteria on executive pay, stock-based executive pay. I did a study of Rolls-Royce jet engines, and even as it was doing well, the executives were not making anything off stock-based pay because they had to do better than the FTSE 100 and 19 other comparative companies. In the United States, there generally has not been any kind of performance criteria other than now where there's stock awards, which are different than stock options, where it's hitting earnings per share targets. And that's great because you just go and you do the buybacks, you hit the targets, and because the buybacks are basically done, you know, on a large scale on particular days. And so in the United States, and, you know, this is true around the world. I mean, the problem is that it's such an inbred ideology now that did not exist at the beginning of the 1980s, you know, maximizing shareholder value. I was at Harvard Business School when it came in there, and then they hired Michael Jensen. And in 1984, no one was teaching this stuff. 1986, everybody, that was dominating. And partly it was because the MBAs were starting to go to Wall Street to make lots of money, and that had shifted. The other thing is the vast majority of, almost every Harvard Business School professor, other than Jensen and the people he hired, didn't believe this stuff because they knew it was a bunch of crap. But the executives, you know, once you started paying them this way, and once you started saying, if you don't do this, you're not going to, you know, stay in this company or run the company, they all started doing it. And now nobody objects to it because they all sit on each other's boards. They all hire the same compensation consultants. The compensation consultants never rate their CEO who's hired them less than 75th percentile, and it's just a ratcheting up. Every time the stock price goes down, they said, well, that wasn't our fault. The market's down. So they said, yeah, we'll get the stock price up, give you more options, give you more. I documented this in this paper done for the Roosevelt Institute called Taking Stock. Anyway, it's so, and the amazing thing is that if you're running these companies, you have to know that you're giving away this money to people who don't matter. Now, the hedge funds are become a big factor since the mid-90s, but nobody speaks out against it from the industrial companies. Now, there are a few people from McKinsey, from Lawrence Fink from BlackRock, who are looking at the bigger picture and who are not in the industrial companies. In BlackRock's case, they're managing pensions, and they're saying, who's going to have the pensions that we're going to manage if this keeps going in this direction? There's a bit of activity about this, on this, and even the fact that I got an article in Harvard Business Review on this has to do with a change in kind of mood, let's say, because it's become so extreme. And of course, the success of the Piketty book had everything to do with the inequality numbers, not with the 750 pages, but without that, I mean, that was the hook. And as I said in my talk, I mean, he himself, I mean, it's labor. I mean, that's what he himself, and then people have done work on using the same databases on the occupations of the people who occupy the top 0.1%. It's people who have got control of organizations as employees and say that's ours, and have used the stock market and shareholder value ideology to do this. That's the real problem, and maybe now it'll start to be confronted, but it became so dominant and so unquestioned, and not just by conservatives, by the Democratic Party in the United States, by the labor movement. Yeah, I mean, I just wrote something on the Harvard Business Review blog on General Motors, where basically taxpayers and workers have been totally ripped off by the hedge funds coming in now. They just agreed to pay them $5 billion in buybacks, and the head of the UAW said, "Well, we think it's premature and too much," rather than say this is robbing, our employees who just took, 20,000 layoffs, went a lot of them from $28 an hour to $14 an hour, all kinds of benefit concessions. It's just such a weakness of the labor movement. It demands no respect in this regard.
Thank you. Right, can we have some, I'll take these two questions. We'll take one at a time. And could you tell us who you are, please?
Thank you. Dr. Stanislav Shmelev, Environment Europe, Oxford. I would like to ask Mario regarding the sectoral specifics of unemployment in the EU peripheral countries. We know that certain members of the European core evolve quite similarly in terms of unemployment. If you look at the unemployment trends of Germany, France, and Italy, you will see that they are almost exactly following the same pattern with a slight lag. What about Greece, Spain, perhaps Portugal and some other, southern Italy and some other countries?
Well, Greece accounts for 1% of industrial employment of Europe. And of course, the only sector where it has a significant employment share is hotels and restaurants. So you're really looking at a situation where the lack, the Southern Europe, including Southern Italy, is basically a latecomer to industrialization. And therefore, what you have seen is some effort to catch up in some traditional manufacturing industries with some success in some areas, in Spain in particular and in Italy. But then the globalization dynamics put these areas in open competition with emerging countries, and the traditional export areas of this cluster of industries in traditional sectors tended to be Mediterranean countries, so low middle income markets rather than top income areas. So what you see is that within all of these countries, within Italy, within Spain, between Catalonia and the south, you have a huge polarization within the country structure, and by and large, you see the crashing of all the sort of more dynamic industries. Italy is a major case where you had a continuing closure of all medium and high technology firms, which have been either closing down or sold to the Chinese. The latest case is Pirelli Tires, which has been sold half to the Russians a few years ago, and now with a majority stake to the Chinese, ChemChina. But you have the same happening in steel. In cars, you have the merger between Fiat and Chrysler, which is basically moving out of Italy production. You have the same dynamics in telecoms. You have the same dynamics in the chemical, the machinery. And what you also have there happening is that in the only areas where there is some dynamics, the continuing investment in local skills, in Italy and Spain, you have, for instance, good machinery competencies and so on. We have German multinationals coming in and buying the core companies of the networks in local production systems. So you have a greater integration into the dominant German-based production system in manufacturing, and the losses of all the high potential, fast-growing, fast-innovating activities. So these, if you look at these structural dynamics, basically you see that there is a weakness which is going to compound over time, because the opportunities for new jobs are increasingly only in low-wage, low productivity, low innovation industries where the competition from global producers is stronger, or in niche markets protected from competition, like the tourist industry, but where you have different types of weaknesses and, of course, very low wages and low potential. So unless there is an understanding that this evolution of production structure is a crucial element of the divergence of European economies, clearly there is no financial dynamics, no public debt policy, no macroeconomic policy that can reduce the structural imbalances that emerge from this diverging structural change. And of course, this, as soon as the recovery comes, there will be a huge current account deficit in all Southern European countries because they don't have any more production capability. And how do you deal with this? With more debt and with more financial flows from either private or the Spanish case, or public, the Greek or the Italian case. So there is no way of breaking this vicious circle unless we address the industrial capacity, in my view.
Thank you very much. Thank you, Mario. The gentleman there in the back.
So I'm Ignacio González. I'm a PhD student in the European University Institute. And my question is for William and Marie, and is the following. So there is a very recent literature and rising that tries to explain the decline of wages and the decline of the labor share in terms of the rise of robots. That it is that because the price of capital goods has been falling during the last 30 years, and because capital and labor are somehow substitute, labor conditions are getting worse. But this view is somehow the opposite that your view, because this view is based on, according to this view, it is firms are investing too much that are displacing labor. But your view is somehow the opposite, because you are saying that firms are not investing, they are distributing dividends and buying back, doing share repurchases. So how do you see this view confronting with yours? Because this view is becoming very popular lately.
So if you take this book by Brynjolfsson and McAfee, and they talk about things that might happen in the future, like the driverless car. I live in Boston and I go to New York quite often, and I go in an almost driverless car. It's called a train, And the nice thing about going on a train is that I now have more time. I can do some work on the train. Actually, you can take a bus for a fraction of the price of a train, but you can't work very much on it. It's kind of irrelevant to a lot of the examples they give. The fact is, as I mentioned about robotics, why are the Japanese leaders in robotics? Is because, in fact, to develop robotics, you had to have a lot of cooperation right up through the hierarchy of shop floor people, not afraid to lose their jobs, cooperating with engineers about how you replicate what they're doing. There's a literature on this, and so the Japanese, even though they weren't going to get rid of workers, they were developing flexible manufacturing systems to be more productive. Now, of course, that might mean you need less of the permanent employees over time, but it wasn't an immediately, to cost cutting. Now, the other thing, however, is that there is a complementary relationship between efficiencies in production through automation and employing people to work on that platform to deliver services. So, from the time I first started studying economics, it was a long time ago, economists in the textbooks would talk about goods and services, but it was as if, that was just a different type of product. Okay, but there's a relationship. When there's innovation, services are constantly being turned into goods, like, customized software being turned into packaged software, and that provides a platform for more services. Now, one of the things, Marie can talk about this more, but is that we're saying when we look at what is Ericsson investing in and what is Huawei investing in that Cisco isn't investing in, it's in people who can deliver services to the customers, not just the boxes, not just the hardware. And so the more they embed actually the functions, the telecommunication functions into the hardware, and they can just sell this as boxes, and they don't have to have people designing that particular software. They've now, there's all kinds of new things you can do. Now, you see it with smartphones, with applications. It's created a whole industry around the world of people who can write apps for smartphones once you have the standard structure in the hardware. So there's no evidence of displacement. Now, what I think it relates to what Mario said, there's absolutely clear that if you're going to be in a high-wage economy, you can't have low-skilled jobs and be a high-wage economy. And you used to be able to do that in industry like, let's say, the auto industry in the United States, when you didn't have global competition, and before the Japanese came along. And at first people thought the Japanese were out competing the Americans because of long hours and low wages, but it turned out They were outcompeting them because they had learning on the shop floor and integrated with the whole learning process, which the Americans didn't have. And it turned out that the American workers were productive because the whole system was productive, but those jobs could not be sustained without creating workers who were involved in the learning process. That's absolutely clear. And insofar as General Motors still produces crappy cars, it's largely because even though it knew about this stuff in the early 80s, it was really quick to find out about what the Japanese were doing through NUMMI, and then it did it through Saturn, which is now destroyed. It has not invested in that labor force. And so it's constantly need to upgrade. You constantly need to upgrade the labor force if you're going to be a high-wage economy in an economy, world economy where, goods, services are constantly turning into goods, and then you have to create new higher level kind of skills really to take advantage of these new, productive platforms. And that's what's going on. And you can't remain high wage if you don't do that. And that, of course, feeds back to the education system. You have to be educating people. You have to be spending that money. But it's no use educating people if they don't have the careers. It's just going to be a waste of money. Marie?
I'd just like to add that going back to another study that I've done over a very long period in France of how France developed these skills and why did French firms make these investments over long periods of time, it links into the notion that Mario said of having some form of public investment where firms are not necessarily only going to do what is going to be paid for, but it's giving them a certain confidence to invest. And just to kind of give a concrete example, one of Mario's other specific sectors of industry is, say, healthcare. So if in Europe there was sort of a concerted investment in healthcare so that a lot of the low-cost jobs in healthcare became more skilled, involving new technologies, for example, we would get into this kind of positive dynamic that we've seen in the past in over decades of European nations being able to invest in developing skills with low labor, what used to be low labor, increasing their skills and making the whole sector more productive. But it's not the individual firms who are going to be the one big actor to coordinate that. They will definitely participate in it, but there needs to be an actor coordinating these kind of programs. Now, they won't all succeed, obviously. Some of them will be failures, and some firms will make investments that won't succeed. But it seems like the thing has come to a stop at the moment, and people are debating about, what's more productive labor or capital? In fact, what we need are these projects. Well, this is very French, the grand projet, where you're looking for a kind of a leading vision of where you want certain industries to grow. But I think if we look at some of the industries where Europe has a potential to succeed and growth in productivity in healthcare, for example, that means about how to deal with people getting older, how to make that a more productive industry by giving people some kind of IT tools and upskilling that very low-paid labor force that there is at the moment. But it all needs some sort of a debate like the kind of one that we would have, liked to see about policy initiatives.
Thank you, Marie. Any more questions from the floor? Yeah, there's a gentleman at the back. Tell us who you are.
My name is Paul Holle from WODC Research Institute in the Netherlands. My question is, overlooking the three presentations you gave, is the spirit of Mr. Oliver Williamson hovering around? Are we in a market hierarchy discussion, and now we are focusing on hierarchies again, taking back the role of the market again?
Yeah, okay. Well, I wrote a book 24 years ago called Business Organization with the Market Economy, and I have 2 chapters on Oliver Williamson. Of course, he never responded to it in any shape or form. But basically, besides the fact that what's interesting about his work is it's written so badly, but he actually has a coherent structure. But the structure, here's how it relates, if I can say it very briefly, is that okay, you have bounded rationality, so you can't know everything, and then that becomes a problem because people are going to take advantage of you. And He once, I used to work closely in the 80s with Alfred Chandler, a business historian, and he was once commenting on Alfred Chandler's scale and scope, talking about big businesses. And Chandler said, Ollie, you're talking about lawyers. You know, they're always going to cheat you. And you had the impression of Williamson that sometime early in his life, someone really ripped him off and just cheated him. And this, okay. Now, the thing is, however, if you go through his work, basically he started off with bounded rationality, but then, and some people are going to take advantage of you through opportunism, self-interest with guile. And then he realized, if you look through the work, this is start in 1975, that this would give you always markets, never hierarchies, because you'd always avoid making any commitment. So then in his book, 1985, The Economic Institution of Capitalism, where he pulled it all together, meanwhile, he found asset specificity. But this is totally exogenous. And then asset specificity just drives everything, and that's why you have hierarchies, despite the fact that his main concepts, you always get markets. And then he says, why do hierarchies more efficient? He says because they work things out. That's what he says. They work things out. There's no content at all. Now, I've written on this very explicitly. What happens in the framework I use, what I call it innovative enterprise, or innovation theory, he's a form of agency theory, not shareholder value, but a form of agency, is yes, you might have people who are going to be self-interested. Everybody's self-interested to some extent. Whether it was with guile or not is another question. We certainly have bounded rationality, limits on what we know, so we need to work with other people. Okay, so that's why it has to be a collective process. But here's the thing. Asset specificity is not exogenous. When you're running a company, you're constantly committing to products and processes, and in the face of uncertainty, and then if you want to actually get productivity out of them, you better get your labor force to cooperate with you. Now, you can do it by hitting them over the head, and actually that's not only Marx's theory, that's Ronald Coase's theory in his, I think, way overrated article, you know, on the nature of the firm, a totally overrated article. But that's not the way, in fact, you get high levels of productivity. You get it by sharing the gains of what I'm calling the collective and cumulative careers. That's totally outside the framework of Williamson. And as a result also, it's not by accident, as he himself admits, technological change is totally outside the framework, because you get technological change through this organizational learning, through this collective and cumulative learning. And so what you end up doing is transforming those conditions, which somehow he takes as given. Actually, he calls it human nature as we know it. You know, that people who might, in fact, not want to cooperate with you, once you can give them a job and you can share the gains with them, they become, you know, the closest of buddy. They become a team. And as long as you can continue that process, you're going to have people cooperating. Actually, if it breaks down, you might can run into big problems. But that's what it is, and that's not the direction that Williamson's gone. I mean, it really was to say organizations are basically a massive market imperfection. And the other thing, which is you know, he makes a statement. He doesn't understand history, but he makes a statement. In the beginning, there were markets. No, in the beginning, there were organizations. Actually, markets are the outcome of capitalist development, not the cause. A well-developed labor market is because there's lots of firms that can offer good jobs. The stock market is a result of capitalist development, not the cause. So even in the United States, the stock market has never been an important source of funding of companies. People started investing in the stock market, putting their money into it, once the companies that were there that had some stability. Actually, the stock market only really became well developed in the United States in the 1920s, after what Chandler has called the managerial revolution in American business. So it actually turns economics on its head. What's interesting about Williamson is that he does, you know, cut into certain aspects of reality that need to be dealt with. So it's still what I would call the myth of the market economy. It's still a view that if only we could have markets and we never had to be committed to anybody because, you know, somebody ripped him off when he was a kid, you know, then we live in a much better world. That would not be the case. We'd be poor. We would have no innovation. We would have no productivity, it's an impossible world, but it's the neoclassical world. He's very neoclassical in that sense.
Thank you, Bill. You want to follow up, do you? No, you were done. Okay. Any other question? We're coming towards the end of our time here, and I'm sure the people are going to want to catch the end of other things. I just wanted to throw one last thing at you, at our speakers, and then we'll call it a day. In the 1990s, the recession we had, particularly, and this is maybe a British-specific point, it was called a white-collar recession, even though it hit blue-collar workers too, and it tended to really hit workers in their 40s and their 50s who were kind of relatively skilled in a way that hadn't been the case so much, in my understanding, in the UK in the 80s. What's so terrifying and different in a way about this recession we've gone through recently in the UK perspective is that we've seen an absolute disaster in terms of youth employment, not as bad as some of our other European countries, but from our point of view, a disaster nonetheless. At the same time as we've seen companies not only keeping older workers, but actually going out and hiring more older workers. We've seen a mini boom in employment amongst older workers. So we've seen quite a different strategy, if you like, in terms of employment from big corporates, and it's big corporates as well as smaller firms. And we're still grappling with why that is and what shifted and so on. And it just seems very relevant to some of what we've heard today. So I'm sorry to sort of shift it into a generational question, but this is a big deal in my country. This is one of the top issues that we're talking about. So any kind of light you can shed, I would be much appreciated.
In Southern Europe, this is a tragedy because we are talking about a generation which is really not socialized to work.
Yep.
In these countries, you have the incredible rise of young people not in employment, in training, or in education, which is going to be the marginalized, socially excluded part of people, which is now ranging about 15% in many countries of the 15 to 25 year bracket. And basically, you have, for all of this generation, you have this anxiety about the impossibility of having not just a work, but a life, the possibility of getting married, having a family, and having independence, which is the other side of the coin of the patrimonial society that Piketty was talking about yesterday. So you have a situation where your future is decided by the assets of your family, and you're not an independent subject, an actor of your life. Your success or failure depends on the position of your family and your relationship to that. So we are really returning to the ancien regime model. So that's the end of the marketization, the extreme individualization of market relationship is bringing us back to a context where non-market relations such as the family are the only really powerful, of course the family for the richest. So this is, I agree that this is a major aspect. In terms of developments in labor market, what I see is a real segregation. For the young people, the prospects are totally outside the labor contracts and the labor relationship and the learning processes that was taking place for the previous generation. Because let me just tell you an extreme case. In Rome, public kids' schools by the local, the large majority of people who teach kids are on precarious contracts, and many of them have been signing contracts on a daily basis. So the public authority, the local authority, found that the only way of with budget cuts to save expenditure on that was to give young women which were taking care of kids 30 different contracts, one for each day, so that they could not pay Sundays and holidays. So when you are reaching this point, what type of of career idea you can have. And this is an extreme case where basically you are stuck into a labor market segmentation dynamics from where you can hardly move out. And of course, nobody's talking about this, but this whole generation is not going to have pensions in any way, because with precarization and with outsourcing jobs, of course, there is no possibility for pension. So we are really, this type of agenda that you raise is going to be one of the major challenges for social stability in the future.
Okay. I think we're pretty much out of time. So I'd like to thank all of you. I've got a huge amount from each of the presentations, so thank you to our three speakers. Thank you.
Thank you.